So I think that's what kind of sets us apart, is that vertically integrated. Obviously, there's other groups that have the same, but we're just strong believers that you got to be a good operator. And I think the hot market saved a lot of the mediocre, not so good operators.
Yeah.
And that's not going to be the case anymore.
Josh Appleman, founder and CEO of Appleman Properties. Today, we're joined with Jorge Abreu. George is a 16-year real estate veteran, leads Elevate Commercial Investment Group and JNT Construction with over 8,038 units acquired, and has acquired over $550 million worth of assets. Is Dallas-based. Expert aims to own 10,000 doors. George, if you could just let us know a little bit more about yourself. You've got a heck of a track record. We're excited to have you here today.
Yeah, thank you, man. I'm excited to be here. I guess I'll start you off. So I'm originally from South Florida, studied at Florida International University for an electrical engineering degree. It was during that time that I realized I didn't want to be an engineer, didn't want to work a 9 to 5. And then I started looking into, I knew I wanted to be a business owner, but didn't quite know exactly what. And started doing some research on successful individuals, and a lot of it kept coming back to real estate investing, whether that's the way they built their wealth or if that's how they took their wealth to the next level. So kind of started going down that rabbit hole, and finally led me to start investing in single family. I started doing some fix and flips and wholesaling. At that point, I was working at UPS in the engineering department. But right around when I started making more money doing real estate than I was making with my W-2, that's about the time that I quit and I started doing real estate full time. That was about 17 years ago. I've done everything you could think of pretty much on the single family space. Did a bunch of fix and flips, which led me to then opening a construction company, which is JNT Construction, which I still have, but now we're focused on multifamily. And then what happened about 7 years ago, I got introduced to large multifamily and syndications, right? And it was kind of perfect timing because I had hit a brick wall with the single family, and I had started doing some small multi, did some new construction and also some existing, but to get to the scale I wanted to get to, it was going to be very, very difficult. Just doing, 1 to 8 units at a time. So as soon as I realized that you can acquire these large multifamily apartments, and bring other investors with you, right? Like you don't have to, you alone bring millions and millions of dollars to close on these. Really opened up my eyes, man, and I put all my focus towards building a large multifamily portfolio. So like I said, that was about 7 years ago, and that's where all my focus is now, and going to continue to build out that portfolio.
That's awesome. The journey of starting with single family houses and even wholesaling. I mean, that is the foundation of then getting to where you're at now. The fact that you started with W-2 and then started on the foundational element of real estate, and now you're where you're at. It's time. It takes time to learn all the language and learn the nuances to now you're syndicating tens of millions of dollars worth of properties. Well, in one property, it could be 20 or $30 million. What would you say was an event or something that helped you get into the syndication world from where you were at? What helped you get there?
I mean, really, it was just becoming aware of it, right? Becoming aware that it was even possible. I've always, well, I want to say in the beginning, I would attend a lot of events, especially when I was trying to learn how to become a real estate investor. And I'm someone that when I attend one of these events, I'm trying to get the most out of it, right? And then I'm going to go and I'm going to take whatever I learn and I'm going to put it into action and see what comes of it. At some point, I kind of got stuck in the day to day. The companies were growing, the construction company, the real estate company. And honestly, I stopped learning, right? I stopped going to these events, and I stopped networking. And it really wasn't until I kind of stepped back a little bit and started doing that again, and then got introduced to multifamily syndications. That's what helped me open up my eyes. Hey, there's another path here. And that's really what helped.
That's huge. And then you recognize what really was a roadblock, and then that alleviated really your next propel forward. The syndication world becomes very small when you get to a certain point, and then you know certain players. And I follow you on social and see you guys are extremely active. I think what sets you all apart is you're not just syndicators out there collecting capital to deploy in a project. You're operators, and you've got your construction side, so you're integrated in a sense, and you wholeheartedly need to make sure that project performs. Can you elaborate on how you all are separated on that degree?
Yeah, I mean, we're at this point, vertically integrated. We've got the management company as well. I think early on, well, one, I already knew it was important. The construction aspect was important, right? I learned that with the single family and the fix and flips, and just doing the volume we were doing, it was almost impossible to not have that in-house. At least we couldn't find enough good contractors, and that's why we decided to bring it in-house and control more of that aspect. So when we started the multifamily, I think it quickly became obvious that we were going to have to do the same thing with management as well. And it's more of just that control, like I mentioned, right? And making sure we deliver on the business plan that we're telling our investors we're going to. When you're relying on a lot of third-party companies, there's only so much you can do to push them, right? And so I think that's what kind of sets us apart, is that vertically integrated. Obviously, there's other groups that have the same, but we're just strong believers that you've got to be a good operator. And I think the hot market saved a lot of the mediocre, not so good operators.
Yeah.
And that's not going to be the case anymore.
Yeah, that's spot on. We're operators as well, and when we find a deal that we like, we will close that deal. But we are very, very selective, and it's because we are married to that deal 3 to 5 years, if not more. And we also are going to take the pain of managing it versus passing those problems off to third-party management, and then hopefully miraculously they can perform. It gives us, I think, a huge advantage, because ultimately we are going to make it perform, and the trust to partners and investors, I think, is even greater at that aspect. When you started out, you were flipping houses and finding properties. What did the infrastructure look like? How did you build and scale, and then ultimately grow out of that phase?
Yeah, so I mean, building out that, we had several acquisition associates that were finding deals for us, and then there's probably, I don't know, at some point we had maybe 10 or 12 on the real estate side altogether, and then on the construction team, at one point the team was pretty large. I mean, we were doing about 30 or so fix and flips on average a year, and then several more wholesale deals, and then we started doing some new construction on top of that. So I don't know, at one point I think that the construction staff was 20 plus, not to mention decided to open up a roofing division on top of that. So we had a whole sales team on that side. So that was pretty much at like the peak, right? When I continued I wanted to scale and scale and scale. But then when I started transitioning over to multifamily, the team actually became a lot smaller, because we didn't need all of that staff. And now our team, is once again, we're in growth mode. So I mean, the real estate team is getting larger, and obviously if you count the property management, definitely more employees now. But it's just essential employees, right? Like we're not heavy on the overhead. And same with the construction, just I think we've got maybe 10 or 12 right now on the construction side. And then I think we're creeping in around 10 on the real estate investment firm. On the management side, there's much more.
Yeah. And it's different when you have a transactional company, a larger transactional company. You need a lot of people to put in front of all the motions, and it's very transactional. You have to, and it's all just it's a lot of work. You got to have people to manage it. We built a large flooring company, 9 locations, 52 employees, and it's a lot of just in and out work, transactional. And at the end of the day, you got to go out there and do it again. And
Yep.
it's grueling. It's fun being in growth mode. It's exciting. Take a step back, and there's other things you can do as well that require a lot less people, and it can be exciting and rewarding as well. Just like real estate, multifamily, you can do a lot less multifamily, and still get the same rewards, if not a lot more. And I think that's the transitional piece. Once you learn the language of real estate, then you get into multifamily and learn, then you graduate and grow more. And now you guys, I see you guys are closing on Class A properties that a lot of us, we're always looking up to guys like you, George, because you're blazing the path. You're proving that it can be done. Let's talk about your recent acquisition, what it is, the Capex, and how big it is, and how you all ended up taking it down.
Yeah, so we just finished closing, I think it was a couple weeks ago now, on a Class A deal in South Dakota, Rapid City. It's a market that we're already in, and we've been successful with 2 other deals there. We've always been looking for more, and luckily this one came across our desk from a seller that we had already bought a deal from before. So off market, pretty low basis on a Class A deal of this type of build. Pretty much the developer was the seller. They built it in 2008, I want to say, and our purchase price was in around 160 so a door. And they built it. They were going to hold on to it. It was going to be like a trophy type property for them. But then the actual owner passed away, right? And
Oh, wow.
Now it is children that are running the company, and they didn't feel the same way. I believe they're in another state, so they didn't want to have anything outside of their home state. So that's how we were able to get into there. It was full cap. And sorry, I'm already on to, as far as capital stack, I'm already on to the next deal that we have under contract now. But I want to say it was around the 70 million mark or so. We had
Nice.
to raise 20 million. Yeah, we had to raise 20 million on there. The raise was a little slower than we would have liked, mainly because not a lot of people know where South Dakota is, and we experienced this on our other 2 deals. But once you look at the data and you educate the investors, they get it. They know why we're there. We've also got the track record there, right? So that helps. So as far as the business plan,
Sorry.
yeah. So as far as the business plan, and this is why we love these A-class deals, and we've been doing more and more of them in the last few years, is, like I mentioned, this was the developer, right? Still the original developer owned it. They pretty much were comfortable with the deal, and they weren't pushing rents. So right off the bat, when we did our research, I mean, we were $150 to $200 lower than the competition, right? So we knew right away we could come in and capture that loss to lease, and then also do some upgrades and get even more on top of that, with a little bit of work, not even a ton of work, right? Like nothing that we would do on these older Class C type deals. So we're just doing some minor upgrades on the interior units, some stainless steel appliances, backsplash, nothing out of this world. And then upgrading some of the amenities. We're adding a pickleball court and kind of freshening up the clubhouse / leasing office. And that's it. It's Capex is right around, I want to say 1.1 million.
Nice.
So not a ton when it's a $70 million deal. And the other great thing about this, and we've done this with our last, I want to say maybe 4 or 5 deals.
Oh, wow. Let me turn this off real quick.
Yeah.
I was afraid that was going to happen.
Yeah, it's that national thing, right?
Yeah. That's
I silenced my phone, so I guess the alert came up, but okay.
We're back.
You let me know when. You good?
Yeah, we're good. $1.1 million Capex and backsplashes. What
Okay. Yeah, I got my train of thought back.
Yeah, on this particular market, is it a emerging market, a path of progress market, established market?
Yeah, I mean it's growing. I mean it's God, I forgot the exact statistic, but 7 times the national average of population growth is what's been happening there for years. You've got several corporate companies. It's actually considered the friendliest small business state, South Dakota.
Yeah,
and really good policies in place, and obviously job growth and population growth are the main things we look at, and then also affordability. So if you do an affordability test on this property, the residents can afford a whole lot more than what they're paying right now, which is always a good thing. And I was saying, or I wanted to go into one of the things that we've done in the past now, and I think our last 4 or 5 A-class deals, when we're negotiating the PSA, we actually get the seller to agree to start doing our business plan and doing our rent bumps. So per the PSA, on their renewals, they had to offer our rents from our pro forma. So by the time we closed, because we ended up extending this a little further, there was also a lot of renewals happening in the next few months. That was another reason we really wanted to push this, so we wouldn't be behind the 8 ball. We were, I want to say it was close to about 60% of our pro forma end of year 1 NOI already, just from those rent bumps.
That's incredible. And you had a willing and able management company in front of you that's able to push them. And that just shows, well, that shows you the basis, the delta between what they were putting them in at and what the market was dictating. So that was a hell of a find on your all's end to even see the property and notice the deal and that's 160 or 170,000 per unit, brand new, 160.
2008, but I mean, still
but,
a really, really good build. I mean, they took care of it too. That was another thing, there was a ton of CapEx that they spent on a yearly basis. I think actually, from the time we had it under contract, they redid the entire parking lot, resealed it and everything. So, a good seller. We've bought from them before. We knew they took care of their properties.
I mean, 2008, new electric, plumbing. You don't need to worry about the 1970s cast iron and all the other good things that come with those properties. I mean, it's just you got to buy at a higher cap to offset the expenses going out on older properties. But if you buy a newer property, buy at a larger, higher basis, and it all evens out at the end. Very cool. What's the plan with JNT Construction? Continue growing it out as the portfolio grows?
Yeah, pretty much. I mean, we started doing more third party here and there as well, working with other investors. At first, it was mainly just our deals, but just continue. I mean, there's a big gap there for good multifamily contractors.
Yeah.
So, we see that, and we think we can definitely step in and take care of.
Yeah, labor pool is a major challenge everywhere. Finding good, competent crews that can get out there and get it done, show up on time, and Just do basic customer service, common sense, just communication. It's
Basic.
difficult, which at the same time, though, that's if you're vertically integrated, you've got crews, project managers, you've got pieces in place. That's a competitive edge. That's what sets your organization apart from the rest, and plus keeping cost to where it makes sense. When we had third party in front of us, there was a lot of money that was being nefariously spent at problems just to make the problems going away. And once we took over management, we were able to squeeze a lot of expenses down or get rid of them. And we procure labor material at a basis that is desirable. So, and I know that's your all's edge as well.
Yeah, I mean, most of our materials we can get nationally, right? So we don't have an issue as far as pricing on material wise. And then labor, a lot of our crews travel to wherever we go. So we're not, if you look at our portfolio, we're not scared to go to different markets.
Yeah, I think that's something that we're trying to overcome. We're about an hour out of our base here, but just getting into totally separate states, markets, where you are relying more on remote staff. I think once you cross that bridge, then it opens up the doors to a lot of other opportunities. Once you do one, you prove it to yourself, get confidence, courage, do it again. But you all prove it to yourself over and over. What would you say your outlook is for the next 5 years on growth?
This year has been a lot slower than we hoped, right? It's been a price correction and just a tough year overall, right? A lot of things changing and the rates obviously going up at the speed that they did and that trickle effect. So, this year has definitely been slower, but we have gotten some good deals done, which we feel great about. And, we're going to keep pushing. We just got one under contract here beginning of this week. So I think next year's going to start off just as slow probably. My guess is towards the end, it might start picking up and then kind of just picking up every year after that.
Yeah. Right now, compared to last year and year before, everything's on discount on that perspective. Once the rates do signal coming down, though, I feel like it's going to be just shoot through the glass ceiling. And
yeah, it's gonna be crazy for sure.
So it's like buy whatever you can find right now. If it's a 8 or a 9 cap, just sit and wait. It's tempting, but until there's going to be a lot of turbulence. So I think next year as well with the election and everything that we've got going on, it's just uncertainty and a lot of even banks you can kind of tell everybody's just tightening up, just seeing what the next move is. So what have you seen out there with deal flow and brokers and the talk out there?
I've seen the prices are coming down, for the sellers that actually have the equity and can take less. They're willing to take less. And then there's the ones that are over leveraged and they can't take less, right? There's a lot of that out there.
Yeah.
And those are going to be a process. I don't see this plethora of deals coming, right? That are, it's going to be a process where the lender, whether the lender's going to want to budge and adjust some of these loans, or if they're going to foreclose on it and take over it. There's a lot that's going to have to happen there before a deal's actually ready, to be sold. So I do think there's going to be some of those, and I think a lot of them aren't going to make it to the market, right? It's stuff that's going to be done kind of behind the door, and some of it's already being done. So we're looking forward to those things, and we think we're going to find some opportunities that way as well. But if somebody thinks that there's just going to be a ton of deals popping up left and right, I don't think so.
Yeah. There's definitely deal flow, but the seller, there's still concessions that need to be made. Yeah. It's just environment's different. I know that brokers, there's a lot more outreach right now on brokers front as far as just seeing who the players are that are still wanting to buy. And they're softening. There's it's on every front, but what it turns out to be is we'll see. For someone wanting to get into real estate, their multifamily specifically, what path would you suggest that they go down?
Wanting to get on the passive or active side?
But let's go down both. Actually, that's good. So if they are wanting to invest in real estate and not really sure how or what it even means.
Yeah, I mean, look, if they have funds to deploy, I would highly suggest, even if they want to go active, I would suggest investing in a few deals passively. You want to make sure you vet the deal sponsor, that you kind of like you alluded to in the beginning of this, is find out who's actually running the deal. Like, make sure it's not just somebody that's raising the equity, which is fine, right? You know, there are groups out there that raise equity and maybe help with investor relations and whatnot, but get to the bottom of who's actually running the deal, and then look at their track record and their team, and are they capable of doing whatever the business plan is, right, and performing on it, because that's essentially what's going to determine if it's going to be a successful investment or not. Yes, the location and the actual deal is important, but if you don't have somebody leading it that knows what they're doing, then it's not worth anything, right? And then after that, you know, you can also maybe talk to that group, and some will let you kind of see some of the stuff on how to maybe attend some of the asset management meetings or whatnot. I know we've done certain things like that before, for somebody looking to be active and wants to see more. And then the ultimate goal, if your ultimate goal is to be active, I think you really need to be thinking about what you can bring to the table to an experienced group, so you can learn from them, whether that's, you know, you've got a great network and you think you can raise equity, or you really know how to hunt for deals, and you're good at building relationships, and you think you can find, you know, get that deal flow, or maybe it's you're really good with numbers and you can underwrite deals, whatever it is, you know, figure out what that is, and then offer that to those experienced groups, and learn from them. I mean, that would be my suggestion.
Yeah, that's great. Just to get into the room and learn from firsthand experience, and find out what your value is and how you can compound it. That's huge.
Taking all the free content out there, right? I mean, there's a bunch of podcasts like this one, right, and books, and, you know, take all that knowledge into.
Yeah, what books would you recommend somebody read? Because one book can make someone pivot.
Oh gosh, you know, a book that really explains multifamily syndications. I like Joe Fairless's, you know, Best Ever. He does a great job kind of breaking down every aspect of it. And then, you know, for passive, I don't think there's a really good book for passive investing.
Just learn the language and learn the industry. Yeah, I'm with you. Oh, and learning the how to even find out what your passive returns are. That's George, I apologize. Hold on one second. Oh God.
Oh my God.
This phone. I turned it on as I knew I had to get messages in, and figured, it's crazy. We're here. But learning books or reading books, learning how to invest, learning the language, learning how to underwrite your underwrite your returns, and against what the GP is putting out there is huge. But yeah, absolutely. What about masterminds? I know you're in quite a few. You put those out there. What masterminds would you suggest a potential real estate investor getting into?
Well, I'm part of Investor Fuel, so I got to put that one out there. It's a great group. It's got a single family side to it, and then also a multifamily, or we call it cash flow group. We meet once a quarter. You know, we really try. We've kept it somewhat small, right? So it still feels like a mastermind. It's not like you're going to this massive conference. Like I know some of them have really grown to where it's kind of not really a mastermind anymore. So, you know, we sit down and just discuss what we can do to take us to the next level, and things that you don't really learn possibly on a podcast or a book, right? It's things that other groups are actually implementing and doing in their business to scale it. that's really the only mastermind that I'm a part of. I know there's a bunch of other ones out there. I think, look, anytime that you can get together with others that are in the industry and that are being successful, and you can share ideas with them, I mean, that's priceless.
Yeah, I totally agree. Get in the room, the energy, the talk, just the talk on passing other people's conversations can, it's level you up for sure. That's huge. George, we truly appreciate you coming on the show today. Apologize for the disruptions that the government put out there for us.
It's all good.
If somebody wants to reach out and get a hold of you, how can they get a hold of you?
Yeah, they can email me. It's George or Jorge, Jorge at elevatecig.com. They can also go to the website, elevatecig.com. Stands for Commercial Investment Group, so elevatecig.com. Bunch of free content on our website, and it's probably the best way.
Awesome, man. I look forward to continue following you, and love what you're doing, man. Appreciate your time today.
All right. Thank you, Josh.
Thank you.